Welcome back once again. Today, I want to show you something that completely changed the way I see the market. This isn't just about Bitcoin, it's about how money actually works inside the financial system. In this video, we're going to understand something that, from my perspective, is absolutely key: the hierarchy of money. We look at how capital moves during periods of stress, why certain assets like cryptocurrencies tend to fall first, why stocks follow afterward, then commodities, and what happens when the problem finally reaches the heart of the system. To identify key zones, how to interpret volume, and how to plan entries without relying on predictions. Because once you understand all of this together, you stop reacting to the market and you start understanding it. So, with that said, let's begin. I'll be honest with you, I didn't always see things this way. As you know, we all evolve little by little in this space. There was a moment around October 2025 when we experienced that historic drop and massive liquidation event in Bitcoin. It was a day of huge liquidations, and suddenly nothing made sense anymore. The market started behaving in a way that didn't match anything I had learned before, and that's when I realized something uncomfortable. Markets don't work the way they're usually explained to us, so I had to start from scratch and try to understand the real logic behind these movements. And that logic has a name: the hierarchy of money. As I've mentioned in previous videos, the financial system works like a pyramid, a hierarchy. Not all assets matter equally. When financial stress appears, money doesn't live everywhere at the same time. It exits following a very specific order, always starting at the bottom of the pyramid. And what sits at the bottom? Cryptocurrencies, including Bitcoin. Because in moments of stress, investors don't sell what's weak, they sell what's liquid. When margin calls arrive, you sell what you can, not what you want. And this brings us to the real center of the system: bonds, the true heart of everything. Bonds essentially determine the price of money. If bonds lose stability, everything else loses its reference point. What we started to see were yields rising aggressively, not because someone suddenly knew what inflation would be in 30 years, but because of forced selling and an urgent need for liquidity. Once cryptocurrencies, weak equities, junk debt, and commodities have been sold, only two major sources of liquidity remain. And that's when the critical point arrives. The S&P 500 begins to be sold in order to protect the bond market. Because if bonds break, everything breaks. At that stage, the system enters survival mode. On top of all this, we also have today's political tensions, public statements that would have been unthinkable just a few years ago, strategic conflicts, international power struggles. We're no longer talking only about economics, we're talking about power. And whether we like it or not, that adds real uncertainty to markets. Now comes the most interesting part of the video. All this liquidity, all these macroeconomic movements eventually show up in one place: the chart. Here we have the Bitcoin chart on screen. The chart begins to make sense once you understand that price moves between liquidity steps. Volume is one of the few real clues we have. Institutions need liquidity to enter or exit positions, and that inevitably leaves a footprint. Strong moves without proportional volume often indicate absorption, and that's usually not retail activity. When panic candles appear, like the massive candle we saw around October 10th, many people sell out of fear, and right there institutional volume steps in while retail reacts emotionally. Strong hands accumulate. That's simply how markets work. Personally, I don't try to predict the future. I work with scenarios. I prefer waiting for a pullback after a breakout and then observing volume. If you like the video, drop a like and subscribe if you haven't already. Hope you're all doing great. See you in the next one. Stay sharp. Bye.